You can now trade forecast contracts on economic events. For example, do you think initial jobless claims are going to be higher than 250,000 next week? If so, you can bid on a yes position, and if you're right, you make money. This type of trading is being made possible by a company called ForecastX. Now, these are brand new contracts, brand new to the market, so it's possible the information in this video may change, but I think the contracts sound intriguing, and so I want to take a bit of time to talk about what they are and how they trade. ForecastX is providing markets in a growing list of areas. Their website says the markets range from leading global economic indicators to global weather outcomes. You can bid on contracts based on everything from global temperatures to US real GDP. So why might somebody be interested in these contracts? Maybe to hedge against economic risk or to speculate on global conditions? Well, there are several things that make these contracts really attractive. First of all, they're cheap. Like really cheap. The maximum value of a contract to the trader is $1. Second of all, they're cheap to trade. The only cost to the trader is a 1-cent charge that ForecastX collects on every paired transaction. Essentially, a trader pays half a cent to get into a position and another half a cent to get out. To enter into one of these contracts, you place a bid on either the yes or no side of the question. Now, all contracts must be paired. That means if you want to take a yes position, somebody else has to take a no position. In this way, ForecastX doesn't take any contract risk, and they can make money safely on that 1 cent per pair pairing. As of this video, there's no additional commission or fee being charged. Well, to exit a position, you simply take the opposite side of the trade. So if you entered a position by bidding yes, you can exit a position by bidding no on the same contract. While a contract is live, the price will be made up of a yes and a no position. The total value of the combined positions will be $1.01. For example, if the yes price is 58 cents, the no price will be 43 cents. Contract values are likely to fluctuate up until expiration as the market prices in changing probabilities. At expiration, the contracts are binary. After all, the answer to the question is either yes or no. And that means the contract will either be worth $1 or nothing. The maximum loss for each contract is the price you pay. The most an investor can make on a contract is $1 less the amount paid. For example, if an investor bought a yes contract for 60 cents, and on the event date, yes turned out to be the correct answer, they would profit 40 cents. That's $1 minus the 60-cent paid. If an investor had bought the no contract on that same question for 41 cents, and on the event date, yes turned out to be the correct answer, they would lose 41 cents because that's what they paid. Trades settle daily, so any profits or losses should reflect very quickly on the value and buying power of a portfolio. Trading on margin is not currently allowed, and so all contracts have to be fully collateralized. So if you bid for 10 contracts at a price of 40 cents, you have to have $4 in your account to cover your maximum risk. ForecastX lists what they call an accountability rule on their website. It says that the event position in any one market is 250,000 contracts. Now, theoretically, this means that traders can only trade up to $250,000 in any one market. But the wording in the rules appears to leave the enforcement of that rule a little bit open for interpretation. Another interesting thing is that members of ForecastX receive a coupon, similar to an interest payment, for the cash held by ForecastX as collateral. ForecastX markets this as though investors can expect to receive this coupon, but from what I can see, that depends on the ForecastX member being willing to share this coupon with the investor. For example, as of the recording of this video, the only member showing on ForecastX's webpage is Interactive Brokers. Well, that means a customer of Interactive Brokers can trade forecast contracts, and Interactive Brokers receives the coupon. Whether Interactive Brokers will actually pass some of that coupon through to the investor or not is unclear. Investors can use forecast contracts to hedge against or express their conviction on the outcome of key economic and climate events. They offer a direct method for hedging a portfolio from the volatility associated with these factors. As with any new market, there are a lot of questions that we just don't know the answer to yet regarding who is going to trade these contracts. At first, it makes sense that large institutions, who often have access to faster and better data than even government agencies, will try to use their information advantage to gain an edge in this market. For example, having access to real-time satellite data could help a lot when determining how many US housing starts are likely to occur before a given date. The counter-argument to that is that if ForecastX does enforce maximum position sizes of 250,000 contracts in each market, well, it might not be worth the time and effort of those institutions to participate in these contracts. So what about retail traders? The fact that the only cost to trade is essentially a cent per contract round trip certainly makes this attractive from a commissions and fees standpoint. Also, knowing that contracts can be purchased for less than $1, and the fact that there is zero spread cost presents a really low entry point. This certainly represents a cheaper cost of trading than stocks or options or futures. The danger for retail traders lies in part on the fact that pricing in modern markets tends to be pretty efficient, and publicly traded markets are even more so. For example, if there's a contract that asks, will the US Consumer Price Index be above this value, and most market participants think the answer is yes, then the price of the yes answer will be much higher than the price of the no answer. Without some type of trading edge, investors in these contracts will most likely lose money over time due to the binary nature of the contracts. Well, think about it this way. If you had a perfectly balanced coin, and that coin gave you a 50-50 chance of success, and you paid a half a cent every time you flipped it, in the long run, you would lose money due to that half a cent dragging on your profits. In order to have a reasonably high probability of success in trading these contracts long term, you have to have some type of edge or knowledge advantage. Theoretically, access to these kinds of contracts by public market participants could actually allow markets to better price in real-time information. This could reduce the likelihood of surprise economic events and help stabilize markets. Is trading these contracts something that you're interested in? Let us know in the comments. We would love to hear your thoughts on this.